Last week, we told stories that felt almost unbelievable. A man who promised steady returns and stole billions. Corporations that looked invincible until they weren't. Scandals so massive they wiped out retirement accounts, charities, universities, and entire careers. And if you walked away thinking, I'd never fall for that, this episode is for you. Because today's stories aren't just about fraudsters in the shadows or villains twirling their mustaches. They're about systems that failed, incentives that warped behavior, and institutions that trusted the wrong things for too long. In some cases, the crime was obvious. Lies, fabricated numbers, money stolen outright. In others, nothing illegal happened at all, just a chain of decisions that made the collapse inevitable. What ties them together isn't greed alone. It's confidence without control, complexity that disguised risk instead of managing it. A 200-year-old British bank undone by one trader. A startup sold investors a vision of revolutionary trucks that, in some cases, only moved because gravity did the work. A real estate company rebranded as a tech revolution burned billions chasing a story so big it collapsed under its own hype. A Silicon Valley founder who convinced J.P. Morgan that millions of customers existed when they didn't. A stockbroker who turned persuasion into a weapon. And a Wall Street institution whose failure nearly brought the whole global financial system to its knees. These stories matter, because the next one won't look exactly like these, but it will rhyme. Today, we're going to continue to look at the worst financial crimes and failures of all time. Not to gawk, not to judge, but to learn how easily trust can be misplaced, how slowly risk can build, and how quickly everything can unravel. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. All right, Logan, we're here for part 2 of our financial crime series.
Yeah, it's been a very uplifting week of lots of people getting scammed out of money.
Yeah, exactly. We've been doing these deep dives into these financial crimes, and it's been all I've been thinking about, it feels like, for the past 2 weeks.
It's kind of fun, though.
It is kind of fun. And it makes me think that maybe this should become a recurring segment on the Plan to Prosper podcast, where we do a few more financial crimes every couple of months.
Yeah, what not to invest your money in, too.
Yeah. It's led me to discover some other podcasts, like true crime podcasts, but specifically in like the corporate world or financial world.
There was one I was listening to this morning. It was like white collar fraud or something.
Yeah, exactly. And they're all really well done, and I can understand why people get into this stuff.
Yeah.
We talked about like the true crime hysteria that has seemingly gripped our country for the past decade, and I got into that, and it's mostly around like murders, things that are like the real dark things. But financial crimes are pretty messed up too, and put a lot of people, though they're not going to die as a result of it, they're going to put a lot of people at risk and losing a lot of money. So they should be talked about. Yeah.
I actually noticed, I don't know, a couple weeks ago, CNBC does like a late night true crime, financial crime segment as well. We're not talking about any of those, but there was one fascinating about a financial advisor.
Oh, we'll have to go into that at some point.
Yeah.
Because we don't share a lot of similarities or many at all with these crimes that we talk about, because they tend to be in different realms, but there's overlap for sure. And we want to make sure that obviously what we do, we try to be as transparent as possible in our model and everything that we're doing as financial advisors, and be open and honest with our clients. But it's just helpful to educate people as well about other potential, because not everybody works with us, obviously. So just things to be on the lookout for, both in your advisor and in the companies that you're investing in. Yeah, and just as a quick recap of something we've talked about before, I was listening to, I don't know, the first 5 or 10 minutes of one of the podcasts that was, I can't even remember which of these crimes it was going over, but it was talking about how you want to make sure you're working with somebody that isn't incentivized to sell product because they can go down this path. That's why we've kind of legally set ourselves up in that manner. Exactly. And one of the stories we'll get to is an infamous example. There was a movie made about it, and it'll come later, but a guy that was really, really good at persuading people to buy what ultimately amounted to worthless stocks, and how he built this gigantic business as a result of it, but lost people a lot of money as well. So we'll get to that, but how salesmen can be manipulative, and that's not always the case. Not every salesman is that way, but it's just there's an inevitable temptation, I think, that comes along with.
Because their livelihood depends on it.
Right. All right. So let's get into it. We're going to start with the one that we finished with last week because we didn't really get a chance to actually talk about this one. I just basically read the opening and left it there. So we're going to go back to Barings Bank, and this happened in 1995. I'm going to read the story again so that we kind of contextualize what we're talking about today. Barings Bank was older than the United States. Founded in 1762, it financed wars, advised monarchs, and counted the Queen of England as a client. For more than 2 centuries, it survived revolutions, depressions, and global conflict. By the early 90s, Barings wasn't just a bank, it was an institution, untouchable and unquestioned. And then it was gone. Not because of a sweeping market collapse, not because of fraud spread across departments, but because of one trader, sitting in Singapore, quietly making bets no one was supposed to make, and hiding losses no one thought to look for. Nick Leeson was trusted, young, profitable, or at least that's what the report said. While headquarters celebrated steady gains, a hidden account labeled 88888 was bleeding money at an accelerating pace. By the time the truth surfaced, losses had grown so large that a single employee had erased a 233-year-old bank. Barings didn't fail from bad markets, it failed from blind trust. So we touched on this a little bit last week, but this was the story of Nick Leeson and Barings Bank, a young trader that took it all down.
Yeah.
And this one was an interesting one because I don't think Nick is a bad guy inherently, and I don't think he set out to do this. I think he just got in over his head as he tried. It started with one mistake that he was covering for, and it just snowballed.
Yeah, kind of slippery slopes. How you can think you're doing something right and maybe something not by the rules, but it doesn't matter because you're helping, things like that.
Yep. And he speaks today. I mean, he's out of jail now and talks about it. His story and how important honesty is and being transparent and all these things. Like really does seem to have learned his lesson. But this all started, I guess, we can go back to the history. Barings Bank, as I said, is one of the oldest banks. It was founded in 1762. It was one of Britain's oldest and most prestigious banks. So this had a long, prestigious history of trustworthiness and there's a lot of history behind this bank.
Yeah.
Nick Leeson came in, I think it was in the 90s. He started, might have been a little bit earlier than that, but he was in Singapore working at one of their branches there. And his job was to execute low-risk arbitrage trades, which is basically he was looking at the markets in different countries and trying to find discrepancies in pricing between, I think it was on the, what's the stock market exchange in Japan, the Nikkei 225 or whatever. Yeah. He was looking for discrepancies in the pricing there and trying to buy low and sell high. I think within single days. I think that is the idea of the arbitrage. Does that sound right?
Yeah, you can do it in different ways. You can do it based on a security. You can do it based on currencies. And if the currencies are different, if he's in Singapore and selling or buying or selling in the Singapore currency and buying or selling in the Japanese, yeah, you can do it in different ways. Okay. But it's just discrepancies that traders can pick up on and execute very quickly, like usually within minutes.
Okay. It reminds me of in the last episode when we covered the guy, oh my goodness, what was his name? Who had the FTX.
Bankman-Fried.
Yeah, he built this software, and I'm getting off track here, but I remember he built this software that was doing the same thing but in cryptocurrency, and it would look for discrepancies in prices across different custodians, and he was able to like unleash that software to just execute these arbitrage trades and buy low and sell high rapidly, and it worked for a while. I mean, that wasn't the result of why FTX collapsed, but so it's kind of the same thing. That's what he was supposed to be doing. He was supposed to be looking for these discrepancies and making trades on that. But one day, this young girl who worked underneath him made an error. I want to say she bought something when she should have sold it, or vice versa. She was told to sell a security, and instead she bought it. Mm-hmm. Or maybe it was the other way around. But it cost about $10,000, or I think is what the ultimate damage occurred. It was a $10,000 loss that resulted as this one mistake where she bought something that she was supposed to sell. Nick Leeson, being the good guy that he is, didn't want her to get fired. He wanted to protect her. And so he hid the loss in the company's error account. Explain what an error account is.
An error account is essentially an account owned by the company in which you can fix your trades. So if you buy when you were supposed to sell, you then move it to the error account and you unwind that trade, but the market's moving while you're unwinding. So you're either going to end up with a loss in the account, or you can end up with a gain. But I know we're set up in this manner. I think legally you have to be set up in the manner in which if you end up with a gain, you have to give that gain away. That can't be the company's gain.
Right. That makes sense. So you're not incentivized to make errors in any way. Yeah.
Or try to wait until it's trading at a gain and unwind.
Right.
Yeah.
Yep. And so he hid this loss and this what was the company's error account. I still don't exactly understand the logistics of how this all actually played out, because he somehow turned it then into like his own secret account, kind of. He claims that that's not the case, that he was like, if anybody dug into this, they could have found this out. And I think that's probably true.
Yeah.
But for whatever reason, they weren't doing that. They weren't diving into these numbers and trying to see what was going on. He was able to let this continue for a long time because this kept snowballing. He thought he was a good enough trader to undo this one trade and that would be it.
And then make up for it in the good trades. Yeah.
Right. And so he had this strategy, this like doubling strategy, where he was like, and this is hilarious to me because I knew a guy that once thought he could cheat. Like he figured out the secret to blackjack, and it was if he put however much money down, let's say it's $5, whether he won or lost, let's say he lost, the next bet he would make would be $10, so that he could
on blackjack.
Huh. So that if he as long as he wins that, he makes his money back. But if he loses that, then the next one he's going to have to put $30 down to make up for the $15 that he's already lost. And at some point, he's going to win a hand and he's going to get all of his money back.
I don't know how he did it on blackjack.
Yeah,
I've heard it on roulette,
okay.
And it kind of sounds reasonable,
right?
Because if you just do black or red on roulette and you keep doubling,
sure.
That one blackjack sounds wild.
Yeah, and needless to say, it did not work because you need a lot of capital to support that level of, because if you lose a lot, you're going to be in a big hole, and it only gets bigger and bigger and bigger. Like we talked about how fast it gets. $1 compounded, like doubling daily for 30 days, you end up with like a ridiculous amount of money. So the compounding nature of that takes off. Nick Leeson was kind of doing the same thing. He had this mindset of, well, if I lose, I'm just going to do the double the next trade, so that if I win that back, I get back to like a zero-sum game. And
also, didn't other traders get wind of him protecting the woman, and like other traders were coming to him and saying, "Hey,
I think so.
Can you throw this in the error account too?" Yeah.
So he had people underneath him that were, I don't think they were privy to the extent of basically the fraud that was going on here, but I think they knew like
Nick can make it go away. Yeah.
And he got in over his head, and it kept snowballing on him. The losses grew to over $1.3 billion.
Yeah, in the 90s.
Yeah, which is crazy. Way more than what the bank had in capital. So there was just no way to recover that when it got to that level. Yeah, and eventually it all came out that this was going on, and the bank pretty much collapsed overnight.
I thought it was interesting and funny that the error account was 888. I think it was 5 8s.
5 8s, yeah.
I didn't know in where was he? Singapore or Korea? Yeah. In Singapore, that's the lucky number.
Yeah, I heard that too.
Yeah.
There was no other meaning behind it other than like it's a lucky number.
Didn't know that. Yeah. About Singapore.
Yep, the 5 8s account. So there was like very little oversight that was happening.
Yeah.
Leeson was both trading and handling settlement and reporting, so there was no like separation of duties where somebody was doing one and he was doing the other. He was overseeing all of it, so that's how he was able to maintain this ruse for as long as he did, because people just weren't looking into it, and the money was still flowing, and that everything seemed fine for a while. And he was able to keep this going for years.
Yeah. I mean, I think it was pretty bad mixture of him being overconfident, not really knowing what he was doing, and there just being zero oversight.
Right. So, I think some lessons that we could learn from this is just be aware of, who you're working with and what do they have structure-wise that protects this kind of thing from happening. Are there multiple parties involved in maintaining the trust, oversight, and all these things? We obviously, in our firm, we have a compliance team that oversees the things that we're saying, the things that we're doing, to make sure that everything that we're doing is above board. It's not just we do it, and we also are our own compliance. We have a separate compliance team that oversees what we're doing. And
yeah, they can see our error account. Everybody at our company can see our error account.
Yeah. Logan's not doing this in our error account, which is nice. I think longevity does not mean safety. We're going to see in another really famous story, the last one we'll cover today, a similar kind of concept that was one of the longest standing banks in America collapsed essentially overnight as well. It was for a very different reason. We'll cover that later. That just because you've been around forever does not mean you're immune to falling apart.
That's an interesting point because I feel like that's a big marketing. That's used in marketing a lot. Like we've been around for 100 years, or we have 100 plus years of experience.
One of the oldest and most reputable banks in America. That's not nothing. Like there's something to be said about some.
We've lasted this long. But that doesn't make you invincible.
Exactly. And trust without oversight is not trust. It's exposure. So you can just there's things that without oversight very very quickly can unravel. So I think having a lot of redundancy and oversight and systems can protect companies from this kind of thing from happening.
Yeah. Yep.
Any other thoughts on Nick Leeson and Barings?
I mean, I just thought it was also funny how he was caught, and I'll keep track of time, but a clerk figured out that like 100,000 pounds was missing. Oh. And that was it.
Yeah.
Like they didn't figure out anything else, and he realized, if they figured out this 100,000 pounds, like I gotta flee because they're gonna uncover the rest.
Yeah. Yeah, so like his wife didn't even know.
Yeah.
Like he was hiding that from everybody. He was just maintaining this pressure, and I think he was drinking a lot, and he was just really struggling with what was going on. He knew it was bad, but he refused to own up to it. He refused to, and then I think he eventually fled Singapore and eventually did get arrested.
Yeah, they arrested him, I think, getting off of a plane.
Yeah, they did. Yeah, it's a crazy story. Look into it more if it's fascinating. I want to think he's a good guy now that he's learned his lesson. He seems like he has.
Like mid-50s now, something like that?
Yeah. He ended up getting cancer because the Singapore jails, like, you don't sleep on beds, you just sleep on the floor. And he was just like, it was so rough. Like, it was a terrible experience for him. And he developed cancer. It has some health problems. Seems like he might be okay now, but yeah. Interesting guy.
So don't do it.
Don't do it. All right. Do you want to take us into our next story?
Sure.
Do you have it?
You can do that one.
All right, I'll do it. Nikola wasn't selling trucks. It was selling the future. Founded with bold promises of zero-emissions semi-trucks powered by hydrogen and electricity, Nikola positioned itself as the Tesla of heavy transport. Its founder, Trevor Milton, spoke in sweeping visions, revolutionized logistics, saving the planet, and leapfrogging legacy manufacturers that just didn't get it. Investors bought in hard. In 2020, before producing a single commercial vehicle, Nikola went public through an SPAC and briefly reached a market value north of Ford. Partnerships were announced, renderings were shared, and promotional videos showed trucks driving across desert roads. There was only one problem. Many of the products didn't work. Some didn't exist at all. One flagship video showed a Nikola truck in motion, later revealed to have been rolling downhill. Behind the scenes, engineers struggled to keep pace with marketing. Nikola wasn't built on innovation. It was built on belief.
This story is fascinating to me. I did a deep dive on this a couple years ago.
Yeah.
And Trevor Milton as a character is just, I think he's just delusional about himself. I think that's best case scenario.
Yeah.
Worst case, he just doesn't care about people and wants to try to defraud everyone.
Yeah, for sure. He reminds me of a lot of the people that we've studied in these that have this unwavering belief in themselves with a legitimate good idea to get that across the finish line. Because why else would I have this amazing idea if it's not going to work? I think it's kind of their mentality. Like, this would help everybody if this really worked. The problem is it doesn't. It's similar to the Theranos girl. Like, that was a really good idea, but it just didn't work. Similar to the Fire Festival guy. Like, cool idea for a fun festival, did not work. And they were just delusional and thinking, this will work. I will figure out a way.
Yeah, this one, I think there were red flags early on, though. Like, did you hear about the guy who got scammed with the alarm system?
Yeah.
And how he was talking to, like, the alarm installer. He was like, Trevor offered this to me for this install for $99. Said it's a great deal. And the installer was like, this is a free install.
Yeah, we do free installs, my friend. So he And this guy was his friend. Like they were buddies. They were doing stuff together.
And I think it's the same guy that ended up going into business with him at D-Hybrid.
He did, yeah.
Yeah,
yep.
yeah. So he got scammed by him and then still, so I guess that's where charisma also, like he just had such good charisma that even though this guy got scammed once, he decided to still go into business with him.
Yeah, and it's funny because he was sharing that how like he would give him deals, like he would do, I forget what he was doing at the time before he was doing the electric truck kits. He was doing something else, this guy.
Oh yeah.
And
it wasn't it was just like engines in general because he put one on Trevor's motorcycle
yeah. But anyway, they would talk about like Trevor would be like, we're buddies. Like, can I get the buddy deal? And so he would like offer it like at extreme discounts to him. And then on the other side of it, Trevor's charging him $99 for an install fee that doesn't actually exist and claiming, yeah, we're buddies. Like, I'll give you this discount on this when it was actually free the whole time. So
yeah, the guy was like, I got the buddy deal.
Exactly. And so he then started this guy, I can't remember what his name was.
Mike Shrout.
Okay, Mike Shrout began installing these kits on cars that converted them into semi-hybrid cars to reduce emissions and make them more efficient and even a little bit more powerful too. And that was Trevor's first taste of this concept, like souping up a truck with this technology could simultaneously make it more powerful and more efficient, and he just couldn't get it out of his mind from that point on, I think.
Yeah. Couldn't get out of it. Saw the dollar signs. Because even when they went into business together, Trevor first tried to take all the credit by filing a patent only in his name and opening the business only in his name when he did a handshake deal with this Mike Shrout to do 50-50.
Right.
See, I think Trevor was it seems like he was very driven by the money, and he didn't, even though he had all these buddies, he didn't care who he really burned.
Exactly. Yeah, and the guy he trusted Trevor when he shouldn't have. They should have gotten lawyers involved and drafted an agreement or anything, but it was just a handshake deal, promised a 50-50 partnership, and that wasn't the case at all. But anyway, so let's zoom out a little bit. The idea of Nikola, when that company was finally formed, it's a pretty cool idea.
Yeah.
So hydrogen-powered semi-trucks with like an infrastructure of stations around the United States, around highways across the United States, where Nikola not only is providing the trucks, but they're providing the energy that powers the trucks too. So I heard one podcaster be like, it was essentially like if if the next Ford Motor Company was also ExxonMobil.
Yeah.
Like that he had this great vision. It was like a tech energy company, essentially, not just a truck company. He was providing the infrastructure and the ecosystem of these hydrogen-powered vehicles in addition to the trucks themselves.
Yeah, and it sounds like a great idea. Sounds like a very profitable idea, but you also have to execute.
Exactly. Yeah, so can you explain a little bit more about these hydrogen-powered trucks, what exactly they offer, like what made that different from what we were used to seeing at the time?
Yeah, at one point they didn't make a deal, but they brought in Swift, which is a big logistics freight company, and Swift did a test drive on one of the trucks that Mike Shrout actually kind of made work, and they said it was something like 63% in fuel savings, so it was going to save trucking companies a ton of money if it was actually legitimate. The hydrogen, the thought there is that it's cleaner for the environment. So yeah, they had those kind of big ideas.
Yeah. And he would go on these, have these trade shows where he would have the actual vehicles on stage, and he would make claims that this is not just a pusher. Like,
right.
I guess that's a thing, which is funny considering the video that they show later, but that car manufacturers, this is a known term in the industry for having just a prototype that's not really functioning, but you just have to push it to make it go. But it shows you what it will look like, essentially. Mm-hmm. He was making the claims on the stage, this is not a pusher, this is a fully functioning truck. But that was not the case at all. No.
I don't know if they got, Mike got that one truck to run. I don't know if they've really ever had a product though after that. Well, Nikola, at D-Hybrid, he got that one truck to run. At Nikola, I don't know if they ever really had a product.
Yeah, certainly not before he was convicted. Because I think they're still in operation. I should have checked that. They're not. Yeah,
I can't remember.
But it's similar. WeWork. We'll get to that in a second. Like that is still in business. But it's not
kind of.
It's not what it was.
Right.
So anyway, yeah, so the company was growing rapidly, and the time came for him to go public. But instead of going public the traditional way with an IPO, which requires a lot of disclosures about how you're going to make money, things like that.
Banks do a lot of underwriting.
They went a different route through an, is it SPAC? Is that how you would
SPAC.
say? SPAC?
Yeah.
Okay. See, it shows how little I know about this stuff. Explain what that is.
It's essentially a shell corporation that goes public and then can merge with an actual corporation later. So the SPAC goes public, merges with Nikola, and now Nikola's public.
Yeah.
There's still oversight and regulation, but less so. There's a lot less looking at historical books and a lot more looking at forecasts.
Yeah. Stands for Special Purpose Acquisition Company, and it was the perfect thing for him because he didn't have to disclose as much as he would have otherwise if he was doing an IPO. And at that point, when that happened, the company was valued at over $30 billion, which was more than Ford was valued at.
Yeah, and it was getting close to General Motors, I think, as well. Which
is crazy because it became the world's biggest truck maker without selling a single truck. Mm-hmm. Just goes to show that like hype can send things, and we've seen that with a few of the stories that we're covering in these two episodes, that hype alone can really get you far before it all unravels before you if there's nothing substantial underneath the hype.
Yeah. Also diversify. Because at one point we got some of our clients into an actual sector of the market, and I wasn't sure exactly how to do it at first. And I'd seen one company that went public via SPAC, and so it was very volatile. Didn't realize that there was actually a diversified ETF, so we ended up using that. But I wasn't just going to start investing in a SPAC because who knows?
Right. Yeah. Due diligence, diversify. I don't think a SPAC necessarily is like a major red flag in general. I think it's...
You need to do a lot more diligence if you're
exactly.
getting into a SPAC than if it's a traditional IPO. The banks are doing a lot more diligence with the traditional IPO.
Yeah. So this ultimately came to a head when this Hindenburg research report came out, and they like unraveled and unveiled a lot of the fraud that was going on behind the scenes, and that was pretty much the beginning of the end for Nikola.
Yeah, I think shortly after that, Trevor Milton resigned.
Yeah, the big I don't know, smoking gun, if you will, was this video that they came out with that you've talked about on the podcast before. But explain what happened there.
Yeah, they made it look like one of the trucks was driving down a flat road I think it was in Utah, and they ended up and it was a video that went to commercial, I think, right? Like an actual commercial.
Yeah, they posted on their Twitter account. I don't know how much farther they went after that, but
I think that the actor came forward and said like, oh yeah, this was downhill, and I had a couple lines, and I don't even remember, was there an engine in the truck?
I don't know. They delivered it on a flatbed, and
yeah, I don't know if there was even an engine in the truck, but yeah, basically it was just go, and they rolled it down a hill.
Mm-hmm. And Trevor admitted as such later, and he says, yeah, I never claimed that it was fully functioning. I said right from the get-go that it was just rolling down the hill. But they edited it out and he's like making all these excuses even after the fact when he was caught in this. It's absurd. I saw somewhere that it was like they found a hill that had like, I forget, like a 3-degree grade or something. So it was like very subtle, and it basically looked flat when you saw it. But they did a test in like a Honda Pilot, and the guy just found exactly where that was in Utah. It was around Salt Lake City. Put it at the top of the hill, put it in neutral, his Honda Pilot, and he did the test, and he said he got up to like 45 miles an hour. Like it was enough to like really send that thing sailing. Yeah. So
good cameras can do some magic.
Yeah, it was brilliant marketing to again cover up for some fraudulent stuff. But that was kind of the real issue in that he stepped down shortly after that, and he was convicted in 2022.
Yeah, convicted, sentenced to 4 years. This is the part that I kind of scratch my head at. I guess Trump pardoned him in 2025.
Yeah, I saw that. I don't know why.
Yeah,
I don't know. I didn't look into it, what the reason is, but One thing that I was curious about is just the name of the company itself. It feels fairly obvious when you look at Tesla.
Yeah.
That there's overlap and similarities, that they're basically trying to be the Tesla of the more logistics side of things with bigger trucks. And Nikola Tesla was the guy that both of them presumably are named after.
Yeah.
I don't know if he had visions or I didn't.
Tesla came first.
Sure. But if Trevor was like, I want us to be like partners, essentially, like we're two sides of the same coin here.
Yeah.
It just feels very on the nose. Like, we're going to name ours Nikola.
Yeah. Yeah. That is, I wonder what his thoughts were. I mean, I remember like walking past we have a TV in our office with Bloomberg and seeing like Nikola skyrocketing the actual stock, and just wild.
It's crazy. There was one YouTube comment on one of the videos I was watching about this, and it cracked me up. It said, technically, a truck that doesn't start is indeed zero emissions. So he delivered on one promise.
Yeah. Just stop driving.
Yeah. Any other thoughts on Nikola?
I don't think so.
All right, we got more to get to.
Yeah.
Do you want to take us into WeWork?
Yeah, I will do that. All right. WeWork didn't look like a real estate company. It looked like a movement. Founded by Adam Neumann, WeWork promised to elevate the world's consciousness, not by meditation or philosophy, but by renting office space. Somehow, desks and kombucha became a vision for human transformation. Investors loved it. WeWork wasn't selling square footage, it was selling community, creativity, and belonging. At its peak, the company was valued at $47 billion, backed heavily by SoftBank, and spoken of as a tech company rather than a landlord. Then the paperwork became public. When WeWork filed to go public in 2019, its financing revealed massive losses, opaque governance, and a founder extricating enormous personal benefits from the company. This story unraveled almost overnight. WeWork didn't collapse because the idea was useless. It collapsed because the story had grown untethered from the business.
Yeah, this is a crazy story too.
Yeah.
Adam Neumann is an Israeli guy that came over here with his sister, or maybe his whole family did. But
yeah, at least his sister did, yeah.
His sister was like a model or something. Moved into New York City and founded this company called WeWork.
Yeah.
I think he might have founded another company before that too, but he was just a very ambitious.
He's founded a company since then.
Yeah. Yeah, so this is another one of those ones where I don't think anybody ended up in jail as a result of this. So it's not technically a financial crime. Does that sound right?
Right. I don't think anybody was convicted of anything, basically because it was found out before.
Yeah.
Although, I mean, I think there was financial crime in here, but somehow he just didn't get caught because, like, he was able to sell or borrow against his shares, his private shares in the company, and other employees weren't. So I would argue that there was, there was some screwy stuff going on
for sure. All right, so let's zoom out a little bit. So WeWork was founded as basically it's a co-working space,
with lots of different locations.
Yeah, and the idea was almost like an in-person social network where he wanted this to be like, you come to work here, you're an entrepreneur, and you need a marketing guy. Well, great. We have a marketing guy right over there that can partner with you. So it's kind of companies coming together and almost sharing assets and being able to network together in person in their working space. And it was just, there was beer at 4:30 every day and all these, like just the hip young millennial thing to do. A very cool concept, for sure.
Sounds like a great idea, yeah.
But I think he persuaded venture capitalists to get heavily invested because of more on the tech side of things. And he claimed to be more of a tech company than he really was. It really was just a real estate company. And venture capitalists love tech companies because it's like scalable like crazy. Mm-hmm. Without having to always hire a bunch as it gets bigger and bigger and bigger. You can just set a software go and it'll allow it to grow infinitely. That can't really happen with real estate. The more you grow in real estate, the more necessary infrastructure you have to have as a company and the more cost that comes with it. So it's not scalable to that degree. Yeah. But that's what it really was at the end of the day. So venture capitalists were investing as if it was a tech company when it was really just a real estate company. Right. Yeah. And in investing, you use different multiples for how to invest in tech versus real estate. So there are just different implications. Yeah. At some point, the company ended up being valued at like $47 billion. Yeah. So there was just a lot of money coming in. And also
when companies announce their intention to IPO, they'll start immediately you'll start seeing on the news, if this company IPOs, it will likely IPO at this number, which gives it a value of. So that's what they were doing,
right?
Prior to any of like the real material facts coming out, which always come out during an IPO, or almost always.
Yeah, and Adam Newman was acting just like that typical, like almost stereotypical, like rock star millennial CEO type character, where he's promising this grand vision of what we're doing. And what was the phrase? They wanted to elevate the world's consciousness. When people would ask, like, what does WeWork do? And his like annoying wife, sorry, maybe shouldn't say that. She'd be like, we want to elevate the world's consciousness. Is like, that's what we do at WeWork, which that sounds.
It was in their IPO filing.
Yeah. Like that's our mission.
Yeah.
To elevate the world's consciousness.
I don't even know what that means.
Exactly. I criticize her a little bit because it basically ended up coming out that like the two of them were just running the company, and nobody else really had much say. But he was acting as this like CEO of this millennial company and throwing these like, do you know about summer camp? Did you read about? Yeah. Yep. So what was that?
And there were like videos.
Yeah.
It was all of the employees, or not. It was all the employees were going, and it was like there were videos of like almost like a cult, where he's up on stage and like, we work, like, just like promising the world to these people. Yeah.
So summer camp was this mandatory retreat for all employees. And it was cool. Like you would go camp and there would be like The Weeknd performed there. Like there would be music artists and there would be endless booze and food and stuff. And employees were starting to see like this, how much money is this costing? Mm-hmm. Like just flying here alone was $2,500 for me. And to multiply that by hundreds or however many, maybe even thousands of employees, this can't be cheap, clearly. Where are we making all of our money? And I think investors were just pouring so heavily and believing so much in this idea and this guy, in particular, Adam Newman, that the money was really flowing and he was spending it as quick as he was getting it, I think.
Mm-hmm. Well, at one point, I think this is fact. I hope this is fact, but I'm going to say, there's a story that SoftBank, which was heavily funding them, went to Adam Newman and said, "Be crazier."
Wow, that's crazy. Yeah, one employee said, he's like, the company's proposition was as intoxicating as it was vague. Mm-hmm. So like there was just the elevate the world's consciousness thing. It's just this like, maybe some people find that fascinating, but it's just this vague sentence that doesn't mean anything.
Yeah.
That's kind of the whole ethos of WeWork. It was,
how does that make money?
Exactly. There was no real business model that beyond just like companies are coming and paying rent to us.
Yeah, let's buy real estate and party.
Which is a fine like that could work if that's what you really are. Mm-hmm. You just can't scale it to the point that you were claiming you could.
Yeah.
So I think that's why WeWork is still technically in business as just a pretty basic co-working space.
Well, I don't know how many there are. In 2023, they did file for bankruptcy protection, so they're not doing great. Sure,
but that's all it was. It was a co-working space, but it scaled like it presented as this infinitely scalable thing that led to it getting off the rails.
Yeah.
He even like tried to trademark the word "we." Mm-hmm. He had other business ideas too to piggyback off of WeWork. There was like We. No, I can't remember what they were.
We Grow, which was a private elementary school.
Yeah. So he's this like very ambitious guy, but he just got way too far ahead of himself, like a lot of these stories.
And I would say more delusional than Trevor Milton because he actually went the IPO route and thought, this will be no problem.
Exactly. And I think that's when it exposed the entire reality of this, that there was just massive losses happening. Weak governance, basically just the two of them running it.
It never IPO'd because all the numbers came out. It did after he stepped down and everything, then it went the SPAC route.
Did it? Okay. Yeah. That's funny. So it did survive, but only after a dramatic valuation reset and restructuring. So lots of money was lost.
Yeah.
And he was getting all this investor money, and he had so much stock in the company himself that because the value was so high, he was then selling it himself and getting lots of money. Mm-hmm. Like you said earlier, like he probably deep down knew that this wasn't going to last forever.
Yeah.
So I might as well get out while I can.
Yep.
But he eventually had to step down, and the IPO was pulled. So I think lessons that compelling narratives can obscure just some basic business math.
Yeah. Don't get a big head.
Yeah. Governance failures are something to be on the lookout for. If it's just like
Did you see his God clause, basically?
Yeah.
I don't know if that was actually what it was called, but like he was going to run it forever. In death, it said that like his wife would run it based on the principles he came up with.
Yeah. Yeah, so if there's, similar to the Nick Leeson story, like no oversight, like it was just the top-down company with him and his wife spearheading everything, and they were allowed to do whatever they wanted to.
Mm-hmm.
And with no governance or oversight, that can run away quickly.
Yeah.
And calling something tech doesn't mean that it is.
Yeah, we're a tech company.
Yeah.
We're fintech.
Yeah, exactly. Any other thoughts?
I think we're good.
All right, we got to keep going.
Yeah.
Next up, this one's fascinating. Frank, not a person, it was a website. Frank wasn't selling hype, it was selling help. The startup claimed to simplify the FAFSA process and help millions of students access financial aid. Its founder, Charlie Javice, was young, polished, and everywhere. Forbes lists, conference stages, glowing media profiles. Frank wasn't flashy, it was mission-driven, and that made it powerful. In 2021, JP Morgan acquired Frank for about $175 million, believing it was buying access to over 4 million student users and everything that came with it, their email addresses, phone numbers, things like that. But after the deal closed, something strange happened. Emails bounced, marketing campaigns flopped, engagement was nearly non-existent. So when JP Morgan dug deeper, it discovered the unthinkable. The users didn't even exist. Millions of names had been allegedly fabricated to inflate Frank's value and justify the acquisition. One of the largest banks in the world had been sold a growth story without the growth. The lesson wasn't that JP Morgan was careless. It was that belief, even at the highest level, can outrun verification. Charlie Javice.
Is it Javice?
I think so. I've heard people say Javis.
Okay, I've been reading it as Javis.
That's what it looks like, but I think she's French, and
Yeah.
I think it's technically pronounced Javice.
In America, we say Charlie Javis.
True. I actually have it written phonetically on my notes here because I wanted to make sure I said it the right way.
Oh,
I wanted to respect her enough to pronounce her name right, even if she's not a totally respectable person.
She's not crazy like Adam Newman's wife.
She probably is a little crazy. A lot of people compare her story to Elizabeth Holmes that we covered in the Theranos story last week. That I think the similarities are maybe superficial, that young women with an entrepreneur, a good idea, but really don't know what they're doing and get in over their head quickly.
Yeah, I think she barely even had an idea.
Yeah.
Javis.
Yeah. I mean, I think it's an okay idea that FAFSA.
Simplifying FAFSA is a good idea, but
yes.
Theranos is trying to create something new.
True.
Yeah, this was, and I think a little bit more creative, got a little bit further than this, where she, like, when she realized that people were going to find out, she bought data and hired a data scientist.
Mm-hmm.
Yeah.
Yeah. So yeah, let's zoom out a little bit. So Frank was this platform, this company that was helping students file for FAFSA as they were approaching college. So high school students would go on to Frank and they would help them somehow with the FAFSA process. Because it's confusing. You need to know your parents' incomes. It requires a lot of your parents' details, but some parents maybe get confused by it too. You need to know your parents' assets and things like that. And so Frank was there to try to help hold your hand across that process and ultimately try to save you some money in what you'd be paying in tuition. And so Charlie Javis was the founder, and she was getting a lot of attention as a result of this. She was on TV shows. She was being interviewed a lot. She even wrote an article for, I think it was the New York Times, on like 8 things that people get wrong about FAFSA. And she got a lot of things wrong about FAFSA in that article. So much so that the New York Times had to issue a correction that was like 2 paragraphs long explaining all the things that were incorrect about what she was saying. So she claims to be an expert on FAFSA, but she clearly didn't actually know much about it at all.
She was on Forbes 30 under 30.
Yeah.
I think they later came out and said, "We are so sorry."
Yeah, and so JP Morgan saw an opportunity to get in on the action because if she claimed to have 4 million student users.
Yeah.
And their details, their information, email addresses, phone numbers, home addresses.
The asset details.
And JP Morgan
which would be very attractive to a bank.
Yeah, let's get these kids while they're young
so
that we can get them in their checking accounts, their savings accounts, and eventually mortgages and like.
We'll potentially know how much their parents have. We can start to market to them.
So JP Morgan acquires Frank for $175 million. That's awesome, for everybody involved. Yeah. JP Morgan gets all this user data. Charlie Javis is rich again. I mean, she was probably rich already. She came from a wealthy family.
Okay.
And so like Frank claimed to be this acquisition machine, basically, where it was acquiring all this user data because people were using it. People were flocking to it. The problem was 4 million people did not, in fact, use Frank. It was like 300,000.
Yeah.
So like less than a tenth of what she was claiming is what actually was the reality. She claimed that Frank knew more about their students than any lender, college, or employer could possibly know. That like not only were we getting all this data, but we were getting good data. Like we knew everything about these kids. And so JP Morgan bought into it and acquired this company for $175 million.
Yeah. Shows even the banks can do diligence and get tricked.
Exactly. And they, JP Morgan wasn't dumb. They requested data verification to make sure this was legit. But she was like, well, that's it, not before the deal goes through. Like that's a trade secret kind of Elizabeth Holmes pulled the same thing. It's a trade secret. You can't see all this stuff. And board members were like, at Walgreens were like, okay, I guess that makes sense. JP Morgan fell for the same thing. And so the deal goes through. They were like, okay, give us the data. And Javis knew she had to do something.
Yeah.
So like you said, she hired a friend to fabricate 4 million fake users.
Well, and I guess she spent like $105,000 to buy data, but then the friend like used the data to create synthetic users. So it was all like fake. It was mostly fake and didn't match up with different Yeah. And the one of the red flags was that the database was, I can't remember, 187 or something thousand, or maybe million, whatever big number it is that is the maximum amount of Excel cells that you can have. It was that.
Wow. Yeah. And so JP Morgan finally gets this data and they sent just an initial email to, I think it was about 400,000 of these users. 20% were delivered, so 80% were not, and only 1% were opened. And so they quickly realized that there was something fishy going on. They sued her, and Javis was arrested and charged with fraud.
Yeah.
Long story short.
She ended up with 7 years in prison.
Yeah. She was recently convicted. It was like September of this past year.
Yeah. So when I say she ended up with, that's her sentence.
Yeah. I'm not even sure she's begun it yet. She might have. I can't remember.
Yeah.
But it's pretty. This is fairly recent news. So
yeah.
If you haven't seen that yet, breaking news: she was convicted for 7 years, sentenced to 7 years in prison.
At one point during the process, I just thought this was a funny story. Her lawyers were arguing that she is a Pilates instructor, so she couldn't wear the ankle bracelet.
That's right. And they actually were like, okay. I think they let her do it. Yeah. She was teaching some fitness classes while she was waiting for the sentence to go through. Maybe she can teach Pilates in prison.
Yeah.
Any lessons here? That's similar to a lot of these, that just doing due diligence is a big piece of this.
Yeah. Banks can get fooled. People can get fooled. Do your due diligence.
Yeah.
Don't trust a charismatic founder.
Yeah. All right. Next story.
Yeah.
Do you want to read this one?
Yeah. Jordan Belfort didn't invent financial fraud. He industrialized it. In the 1990s, his brokerage firm, Stratton Oakmont, became a machine built on persuasion. Cold calls, high pressure, promises of once-in-a-lifetime opportunities. Penny stocks were pitched as tickets to early retirement, and brokers were trained not just to sell, but to overwhelm. The strategy was simple: pump worthless stocks with hype, drive prices up, then dump them while clients held the bag. Inside the firm, excess ruled. Drugs, parties, money, all signals that the system was working. Outside the firm, ordinary investors watched savings evaporate. Belfort wasn't hiding complexity. He was exploiting trust. When Stratton Oakmont collapsed, the damage was already done. Belfort went to prison, investors were left with losses, and Wall Street got a reminder that when sales incentives replace ethics, destruction isn't an accident. It's the business model. You read some of his book, didn't you?
Yeah, I started to. It's I didn't want to read any more of it.
Okay.
It wasn't dissimilar. I mean, so people know this movie probably in our country, our culture. Leonardo DiCaprio played Jordan Belfort in The Wolf of Wall Street.
Yeah.
I've never seen the movie.
I haven't either.
But I thought the story sounded fascinating, so a few months ago I decided to pick up the book at the library. But you know, he's just telling his story, and it's similar to how the movie is structured, I think. And there's just things in there that I don't need to be reading about. So I stopped reading it.
Okay.
Because he was flying high as he's pulling in all this money. He was living this hard lifestyle, partying and doing things that he really shouldn't have been doing.
Yeah.
But let's zoom out a little bit. So this is the story of the Wolf of Wall Street, the real Wolf of Wall Street, not Leonardo DiCaprio, but Jordan Belfort. And he had started in another firm in the 80s and was let go from there after Black Monday in 1980 something. Yeah. So then he founded his firm with I think there was another salesman that he partnered with.
Was it that Stratton Oakmont?
So that's when he founded Stratton Oakmont, which sounded very prestigious. Like it was pretty brilliant, and it sounded like there's this idea of longevity and history. Like that sounds like a company that's been around for a while, even though it wasn't. It sounded very prestigious, and turns out they were just in like a warehouse basement at the beginning, just like struggling with like rats crawling around. Like it was just a very low, like that's how they started. They were selling penny stocks, which is that's what Bernie Madoff was doing when he started. Now he wasn't doing it to this extent where he was actually doing the pump and dump stuff, but explain penny stocks for anybody who might not know.
Very low value companies that are selling for typically a penny to $1. Very low volume. They're not on exchanges. So yeah, just very illiquid stocks.
Are they typically young companies?
Young or companies that haven't done well.
Okay.
So they started on an exchange, but then I think it's New York Stock Exchange. Where's the NASDAQ? One of them has a requirement of being at least $5. So then if you're below $5 for a certain amount of quarters, companies try to kind of manipulate a little bit with stock buybacks and things like that. But eventually it could catch up to you, and so you just end up on like the OTC market or whatever and turn into a penny stock. So
is there less regulation involved then when you're not on one of these exchanges? You're on the OTC?
That's a good question. I mean, I think the exchanges have some oversight, but I mean, they're still all under the SEC as well.
Sure. Because what I was seeing was that he was a brilliant salesman. He had a lot of success selling like door-to-door stuff. Like he had this like meat company where he was going door to door and selling meat and seafood, like flash frozen meat and seafood to people. And he was really, really good at it. He made a lot of money because he was just very, very, very persuasive salesman.
Yeah.
And I think he realized when he started Stratton Oakmont that the penny stocks were the way to go because he could pitch it as young companies that had so much potential for growth that he could call somebody and just say, you can get on the ground floor of this thing. It's about to take off and you're going to be rich. Like you'll be in a year, you'll be calling me, thanking me from your yacht, basically. And he was really good at that. And what they would do then was just churn out a lot of these trades. They were really good at it and sell these fairly worthless stocks to a lot of people. And then they would turn around and sell their own shares in them.
Right. So they would buy a block first
and
then start selling over the phone or whatever. Yeah.
And so it would inflate the value of the stock.
Yeah.
And then they would get out.
And then they would dump it. Yeah.
So that's the pump and dump aspect of it.
Yep.
I forget how long he was able to do that for. Because they got extraordinarily successful at this. Years and years.
Yeah. I would think it wouldn't take that much to figure out what they were doing.
Right. I know. He was teaching his salesmen this straight line persuasion technique where you never pause, you never doubt, and you take them straight from hello to closing. And it was just this, it was ingrained in these people. And if you didn't cut it, if you weren't producing, you were out. Like it was pretty ruthless. And the best performers were celebrated and the worst ones were out of there quickly, and they would just bring somebody else in. They were churning through salesmen as fast as they were churning through stocks. It was quite an operation that they were running.
Yeah, and I was reading that the typical success story as far as being a good salesman under him was that you weren't like the typical Wall Street kid. You were a kid from Long Island that just really wanted to get rich.
Yeah. Yeah, he initially wanted to get into dentistry. And it was like his first day of dentist school. And like the guy at the front was just like, if you're here, something like, if you're here to get rich, you're in the wrong place. And he stood up and walked out. He's like, I want to get rich. And that's when he discovered that he could sell almost anything and made a lot of money on Wall Street. And so the culture that he built rewarded aggression and excess. They were getting really into partying. There was a lot of drugs involved, a lot of women involved. And he was married, but he had a lot of things going on the side and just living a lifestyle that was just excess and lavish in every sense of the word.
Yeah, I was reading a story where at one point he got high on whatever drug he was on and decided to fly his helicopter when he usually, and he crashed his helicopter on his property, and the pool boy said like, oh, this is just Jordan Belfort chaos. Like he didn't even bat an eye at a helicopter crashing on the property. Yeah.
I think he took his yacht out in a storm once too. And
in like the Mediterranean and intentionally sunk it. I think.
With his like daughter on board. And they like, I don't know if he intentionally sunk it, but he intentionally made them drive go in the storm. And the yacht was ruined. They all were fine, I think. But he was just reckless. Yeah. In every way. So he was living lavishly, and meanwhile, all of his clients were losing lots of money, millions. So ultimately, he was convicted of securities fraud and money laundering. I saw a story that he had, for the money laundering, like he was hiding cash in his housekeeper's brassiere, and like it was just crazy stuff. And it makes sense that they would make a movie about this because it is wild.
Yeah. Did he go to prison?
Oh, yeah. I think so. I don't know for how long. Yeah. He's not in prison now. Okay. Because he's still very much, you'll see him in he does a lot of interviews these days and talks about his story. And an interesting guy. Yeah. Can't recommend the movie. I don't think that's necessarily something that's worth watching. Seems like there's a lot of bad things in that movie, but
it seems like they portray his lifestyle pretty accurately.
Right, exactly. So lessons, don't let a pushy salesman push you to do something that you don't want to do. Yeah. It's okay to say no. You're not going to go to jail for saying no to a pushy salesman. Right. They might make you feel that way. They might be so good at what they do that they're pushing you, and they might make you feel like you're making the worst decision of your life, but don't fall for it.
Ask, how are you paid? Yeah. If they have incentives to sell you, it's typically, if they have incentives to sell you on a product, it's typically not gonna do well.
Yep. Okay. Any other thoughts on the Wolf of Wall Street?
No, I think we're good.
Last story for the day. We only have a few minutes left. Lehman Brothers didn't implode because of a crime. It imploded because of confidence. For 158 years, Lehman had been a pillar of Wall Street. But by the mid-2000s, the firm was deeply exposed to the housing market and aggressively leveraged to amplify returns. Small gains looked enormous. Small losses became existential. To manage appearances, Lehman relied on accounting maneuvers that temporarily reduced reported risk without actually reducing exposure. On paper, everything looked manageable. In reality, liquidity was vanishing. When housing prices fell and trust evaporated, Lehman couldn't roll its short-term funding. No bailout came, no buyer stepped in. And in September 2008, Lehman Brothers filed for bankruptcy, the largest in U.S. history. No fraud was required, just leverage, complexity, and the sudden disappearance of confidence. Lehman Brothers was founded in 1850, before the Civil War. Huh. They were originally trading like cotton. That was like how and then they got into some other commodities, and then eventually got into investment banking.
Was it started by brothers named Lehman?
It was. Yep. And one of the brothers died fairly quickly, so I think it was like the guy that originally founded it died before they even got into like other commodities. So he died, and it was just simple cotton trading. It was it actually started as like a dry goods store, and they accepted cotton as payment, and then they started realizing they could kind of act as a cotton broker. because cotton was a big commodity at the time. I mean, it's maybe still is, but not in the way it was then. And it kind of grew from there.
Interesting.
Yeah, very fascinating.
Yeah.
So very old, reputable company like we talked about with Barings Bank.
Yeah.
The idea of Stratton Oakmont, potentially. But this was an actual old institution founded in 1850.
Yeah. It didn't survive the financial crisis.
It did not. And why didn't it survive?
They were over leveraged and they had a lot of exposure to mortgage-backed securities. Both the subprime and the Alt-A securities, which aren't prime mortgages. They didn't do great stress testing. They assumed that in worst case scenario, real estate would stagnate. The value of real estate wouldn't fall.
Right.
And they were participating in some legal but not great accounting practices.
Okay. So the housing market at the time in the 90s and into the 2000s was soaring. Housing prices were going up.
Yeah, late 90s, yeah.
Okay. And interest rates were pretty low.
Yeah.
And so a lot of people were buying houses and banks were just giving mortgages out like candy to people that really were not qualified.
Yeah.
Or certainly today wouldn't be qualified.
And so those were the subprime, yeah.
These are the subprime mortgages where people were buying houses with very little, they were high risk for defaulting on their mortgage.
Yep. Yeah, higher risk than the prime mortgages.
Yeah. And so these were bundled then together with a bunch of other mortgages, even good mortgages, into these mortgage-backed securities. And so a mortgage-backed security would have cut up mortgages across a spread out. And the thought was, even if people do default on them, they'll be supported by the other ones. But that really wasn't the reality of it, that the whole thing would come crumbling down if these housing markets, the idea was that we were at a bubble. And if the housing market crashed, that we were in real trouble. And that's pretty much exactly what happened.
Yeah.
Where markets crashed and then interest rates went back up. And because these subprime mortgages were on variable mortgage rates, their interest rates would go up too, while their housing value went down. And so they were suddenly underwater on their houses, these subprime mortgages, and they couldn't pay it. And it was a big issue. They couldn't get out of the house because the value was so low and all these things.
Yeah. Yep.
It was like a perfect storm, basically.
Yeah. And they were very over leveraged, meaning that.
You explain that.
Yeah. Meaning that a dollar of their whatever they were buying was backing like $30 in the assets they were supposed to be holding.
Okay. Yeah. So on paper, their balance sheet was there was very little liquidity in the Lehman Brothers. There was so much real estate, so much debt that they were holding that it was, if something like 2008 happened, which obviously it did, they had very little liquidity to weather that storm.
Right.
Just everything kind of disappeared in an instant almost.
Yeah. Yeah, and then and they were doing this thing called the what was it called? Repo. And there was a number.
Repo 105.
Yeah, Repo 105, where they were basically with a repo, you loan out a security to somebody else with the promise that you're going to buy it back, and they were doing that to kind of hide assets and liabilities. And they were doing it like right around earnings time, so that people didn't necessarily see it.
Yeah. So eventually, when the housing market is in 2008, people were starting to catch wind of this early in 2008, March or so. But by the time summer and fall rolled around in September, that's when they filed for bankruptcy in September of 2008. And I think that the Dow Jones dropped like 500 points that day, and was really the beginning of the global financial crisis of 2008.
Yep.
So we're running out of time here. Final lessons. Lehman Brothers.
Don't get too over leveraged. You need liquidity. And another example of why diversification matters. Diversify your
own portfolio.
Yeah, your own portfolio. Don't just hold one bank. Hold a diverse set of financial institutions.
Yeah. Absolutely. That's great.
Yeah.
This was part 2 of our episodes on financial crimes.
Yeah.
I hope it was enjoyable. We couldn't cover everything. We had to do a very high-level overview, but it was fun to do.
Yeah, absolutely. We've got a episode coming up with a good guest too.
Yes. Tune in next week. We won't say who it is yet, but it's going to be good.
Yeah.
Thanks for listening. Subscribe and have a great week. God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.